Welcome to the Torch Academy. Today we're talking tax planning after selling a business, how to minimize what you owe and plan strategically. Most sellers assume their tax bill is fixed the moment the check clears. It isn't. The structure you agreed to months before closing, stock sale versus asset sale, the earnout terms, how the purchase price gets allocated, is what actually decides whether you hand 30 cents of every dollar to the government or closer to 50. The biggest tax mistake sellers make is treating tax planning as something to figure out after the deal. By then, the decisions that matter most have already been made. In an asset sale, the IRS makes you break the purchase price into categories: equipment, inventory, customer lists, goodwill, and each category gets taxed differently. Goodwill gets the worst treatment because it's taxed as ordinary income rather than capital gains. How that allocation gets negotiated has a direct dollar-for-dollar impact on what you owe. It's one of the most powerful levers in the whole deal, and one most sellers don't realize exists until they're looking at a tax bill that's hundreds of thousands of dollars higher than they expected. Here's why the stock versus asset question matters so much. In an asset sale, goodwill usually makes up 40 to 60% of the purchase price, and it's taxed as ordinary income. That's 37% federal, plus state tax, plus the 3.8% net investment income tax. You can end up handing over close to 45 cents on every goodwill dollar. A stock sale flips that to long-term capital gains rates, which can be roughly half. On a $5 million deal, that difference alone can be 7 figures. Stock sales aren't always on the table, but if they are, the tax math is dramatic. If part of your deal is paid over time, an earnout, seller financing, a deferred payment, you can often elect installment sale treatment and recognize the gain as the payments actually come in. Instead of owing tax on the whole thing in year 1, you spread it over the payment period. That can drop you into lower brackets in certain years and give you runway to make offsetting investment moves. The catch is buyer default. If the buyer stops paying, the tax treatment shifts in ways that can hurt you. So this is powerful, but it's not a do-it-yourself decision. Get a tax advisor to model it before you structure the payments. Where you live when the deal closes can cost you, or save you, hundreds of thousands of dollars. California, New York, and Illinois stack another 13 to 14% on top of federal capital gains. 9 states, including Texas, Florida, Tennessee, and Wyoming, charge nothing at all. On a large deal, the state you're domiciled in on closing day is a real financial decision, not just a lifestyle one. Sellers who plan ahead sometimes time the close or an actual move to line up with the most favorable tax state. This one catches a lot of sellers by surprise. Over the years you've owned the business, you've been deducting depreciation on your equipment, vehicles, buildings, and other hard assets. Every one of those deductions lowered your tax bill in the moment, but at sale, the IRS recaptures them. Section 1245 hits equipment and vehicles at ordinary income rates. Section 1250 taxes real estate depreciation at 25%, plus state tax on top. Sellers who assumed everything was capital gains suddenly find a big chunk of their proceeds taxed at a much higher rate. It's not a loophole being closed. It's how the tax code has always worked, but it's rarely in the mental model when sellers negotiate the deal. The biggest tax wins happen long before the letter of intent gets signed. If you're operating as a C-corp, converting to an S-corp at least 5 years before a sale can avoid the double taxation trap that crushes C-corp exits. Qualified opportunity zones let you defer, and in some cases permanently reduce, gain by reinvesting in designated areas. A charitable remainder trust can convert highly appreciated assets into an income stream for life plus a charitable deduction. And simply timing the close to a lower income year can shift you into a friendlier bracket. None of these work if you think of them on closing day. They're planning decisions, sometimes years in advance. Earnouts look like bonus money. If the business performs, you get paid more. In practice, the tax side is where a lot of sellers get burned. The IRS treats each earnout payment as gain in the year you actually receive it, which can push you into a higher bracket in an otherwise quiet year. If you've moved states, you might also owe tax in your old state on income earned while you were already gone. And buyers have every incentive to structure earnout targets they can quietly miss, which doesn't retroactively fix the tax you already paid on accrued gain. The defense is specificity in the deal documents. Define the metrics clearly and make them hard to manipulate before anyone signs anything. Sarah sold her marketing agency for $5 million upfront, with a $1 million earnout tied to year 2 revenue targets. She planned her taxes against a $6 million gain and moved on. In year 2, the business hit the revenue number, but the buyer had quietly changed their accounting method. And under the new method, revenue came in lower and the earnout wasn't, in their view, triggered. Sarah had already paid tax on that earnout gain. Now she's in a dispute trying to recover money she already gave to the IRS. The whole mess traces back to one vague word in the purchase agreement: revenue. That was never precisely defined. A tighter definition would have cost a few $1,000s. The dispute is costing her hundreds of thousands. Here's the timeline that works. Right now, before anything else, consider getting a tax advisor involved and reviewing the deal structure through a tax lens. This is where the biggest dollars are won or lost. At close, make sure the allocation is documented and every election you qualify for gets filed on time. Within 30 days, understand your state tax liability and get any estimated payments in so you don't stack up penalties. And ongoing, especially if you have an earnout, track every payment and coordinate with your advisor each year so nothing slips through. It sounds like a lot, but with the right help, it's very manageable. Here's the decision point. For a simpler sale, single state, clean structure, mostly cash at close, online tax tools and a tax-aware accountant can handle what you need. For larger or more complex deals, though, think earnouts, a multi-state move, or a C-corp structure. A specialist who lives in business sale taxes usually pays for themselves 5 to 10 times over. The point isn't that you can't do it yourself, it's that the more complex the deal, the bigger the payoff from someone who does this every day. These are the mistakes I see again and again, waiting until after closing to talk to a tax advisor. By then, the decisions that mattered most are already locked in. Accepting the buyer's Section 1060 allocation without pushback when that allocation is almost always written to favor their tax position, not yours. Treating earnout payments like regular cash and being surprised when the tax treatment is completely different. Moving states mid-deal without understanding the nexus rules and getting taxed by 2 states on the same dollars. And simply forgetting about extensions and estimated payments, the IRS penalties on a big gain compound fast. Every one of these is preventable with the right advisor in the room early. The takeaway, the tax bill on a business sale can be enormous, and most of the planning needs to happen before closing. Installment sales, opportunity zones, charitable strategies, and entity structure all affect what you owe. The cost of a good tax advisor is a fraction of what poor planning can cost you. Get this right the first time. There are no do-overs. Thanks for watching. If you found this helpful, head over to torchapp.io/signup and create your free account. Torch uses AI to help you navigate buying or selling a small business. Whether you're just exploring or ready to make a move, we can help. And don't forget to subscribe for more episodes from the Torch Academy.